Good evening, everybody. It is Wednesday, April 29th, almost to the end of April. Markets definitely kind of hanging in there and a little bit of movement today. Let's take a quick look and see how things shook out. We ended up, like I said, pretty nominal day. If you look at the Dow, you'd think it was a pretty significant day. The Dow's only 30 stocks. That was down 280 points, or just over 0.5%, 0.57%. But if you look at the S&P 500, only down 0.04. The NASDAQ up 9 points, up 0.04, virtually flat on the day. Russell 2000 had about the same pullback that the Dow did, about 0.6%. The VIX volatility index up very slightly, but not much. So kind of a non-event day in U.S. markets as far as equities go. If we check out Europe, Europe was down a little bit. The European stock 600, their version of the S&P 500, was down 0.6. The DAX in Germany down a little over 0.25%. The FTSE in the UK down 1.16%, and the CAC in France down 0.39. So a little bit of a pullback today, but probably still somewhat modest in Europe. If we look at bond yields have been trending up, and right now in after hours they're up 1 basis point. But if we look at this move, you can see from April 17th we were at 4.22%. We're up 21 basis points in the last 12 days, and you can see that it's just kind of been trending higher. I think stock markets have been forgiving for the lack of resolution in the war, but the bond market has definitely been pricing in this increased cost of energy, and sure enough, you're seeing long-term bond yields pick up. One thing that I would point out is, though, that economic data that came in, the U.S. economic data has been pretty strong, very resilient, stronger than probably to be expected after nearly 2 months of uncertainty related to the war. But if we look at the bond market, it is pretty darn close to where it was a month ago before the stock market started to recover. And as the market was recovering, yields were coming down. Now yields have been going back up, but the stock market's been staying higher. But those higher interest rates are probably keeping a lid on a continuation of the stock market going up. But those higher yields on the 10-year definitely having an impact on the bond market, probably keeping a lid on the stock market. And what they're likely reacting to is, if we go to oil prices, oil right now back up to $108 a barrel. So kind of that chart kind of looks like that bond yield chart when we look at oil prices peaking, early April, late March, early April, then coming down, but now spiking. So the correlation between oil prices going up and bond yields going up has definitely been there over the last week to 10 days. And yet it hasn't caused a significant pullback in equities yet. I would suggest if oil prices were to keep going up and bond yields were to keep going up, at some point that would start putting pressure on the stock market, but that is not yet putting pressure on the market. If we go back to the S&P 500 for a second, and we can see here, this is after hours stuff, so little uptick in the S&P and the NASDAQ after hours, still a little bit of pressure on the Dow after hours. That's pre-market numbers for tomorrow. But if we go to the S&P and we close today at 71.35, the all-time high on the S&P is 71.78, so we're within 53 points of the all-time high, less than 1% difference. And so when I say that the stock market has been holding up in spite of higher yields on bonds, higher oil prices, it truly has been. And if we look at, a 1-year chart of the S&P, you can see it's kind of, going a bit sideways here. If we look at the last 5 days, here we go. There's a 5-day chart. We'll see. I mean, where we were a week ago, 71.35 on April 23rd, April 29th, 71.35. So the market's kind of gone sideways for a week, but bonds have come down as yields have gone up, and oil prices are definitely likely what's primarily contributing to that. Looking at the dollar, I would say we did have a Fed meeting today. The Fed did announce that they are keeping rates unchanged, which is what the market was expecting. And clearly, you can see the dollar unchanged on the day, kind of in the mid-range of where it's been over most of the last year. So not a big movement on the dollar. But what I would say is that clearly economic strength is an underlying factor in this economy. And I would also say that the market seems to be looking past this short-term bump in oil prices, short-term bump in interest rates that is still causing people to say, yeah, I still don't mind hanging out in equities over here. And part of that optimism, I believe, is attributed to, one, the belief that this spike in oil prices that we've seen, going back to oil for a second, that ultimately, once this gets resolved completely, that we see oil prices heading back down to where they were pre-war, back down into the $50, $60 range. And I think that's entirely possible, but we clearly want to see a resolution. But the market, if you think about it, the stock market staying as resilient and as high as it's been is kind of giving cover to the policy that, at least for the time being, is what has been put forward, which is, if you think about this war process, they spent a month bombarding them and taking out a lot of the military targets, but ultimately and unless you start going after infrastructure like bridges and utilities and things of that nature, which the United States, if you look at history in wars, we have done that to countries where we, are truly trying to decimate them. They're trying to avoid that at the moment, clearly. And so what I would say is the market seems to be content with the status quo. And what is that status quo? The status quo is, one, we've already, done most of the military action that we needed to do to basically defang them. Now we're with the blockade, we're basically slowly choking them off. This is kind of like laying siege to the castle back in the day. They've got the castle surrounded, they're not letting anything in, they're not letting anything out. And over time, there's an economic pressure that's building in Iran. And what I would suggest is that the stock market, as resilient as it's been, and even in the face of these significantly higher oil prices and modestly higher interest rates on long-term bonds, the market's been holding in there, and that really is giving cover to the current policy. Meaning, hey, as long as you don't escalate this and put boots on the ground or begin bombarding them again, the market's probably hanging in there pretty well, and that's what's been happening over the last few weeks. We had the recovery. Now it's kind of hovering in that new upper range that it traded in. But in spite of continuing increases in oil and interest rates, you're not seeing the market get compressed or go down. And if you think about what that is signaling to the administration, is the market kind of likes the status quo. They like the status quo of, we're definitely putting more resources into the region. We're increasing our capability of hitting them hard if we need to, or they decided to. But for right now, the blockade is bad for Iran. I would suggest it's bad for the rest of the world as well, because these higher oil prices are impacting people. But the market feels like it's temporary, and the market feels like it's going to go back to normal relatively soon once this is resolved. But I think that there's a consensus that the risk of ending this too soon is too high, and the risk of escalating, especially without giving a chance for negotiations to succeed, I think there's a lot of risk associated with that the least risky option is the one that they're presently pursuing, which is the blockade. Basically, they're going to run out of space for the oil that they take out of the ground. They're going to run out of space to store that, at which point in time they need to start shutting down wells and shutting that stuff down, which actually is a very problematic process to begin and takes time to reinitiate. And clearly, the lack of ability to get things into the country that they probably normally import, they're going to run out of gas. They're going to run out of places to store the oil. They're also going to run out of a lot of stuff, which is going to add to the pressure that whoever the leadership is in Iran is going to be facing. And I think that one of the challenges that has been stated is that when you take out the leadership like we have, who steps into that void and who fills that void of leadership? And is there a consensus as to who even the leaders are in Iran at the moment, given the fact that the country's in a lot of disarray in light of what they've already been through and what they're currently under being pressured by. So from a market perspective, I would say the market is providing cover to keep doing what they're doing. And ultimately, because of that, I would say that the current keeping their the pressure on them with the blockade is probably what's likely to continue. And unless the market were to start reacting in a negative way to higher prices, and I do think that there is a point where oil prices going up high enough or interest rates going up high enough could start eventually putting pressure on the stock market, which I think then you start getting more pressure on the administration to try to come up with some sort of a conclusion or a resolution to this. But as long as the market remains somewhat range bound, and especially close to all-time highs, I think that that's actually giving President Trump and the administration some cover in not really feeling compelled to escalate or to walk away and just declare victory, which I think that there's a theoretically you could do that at any time. The problem is did you actually accomplish what you were intending when you started all of this? And I don't think that if they pulled out right now you could claim that, and therefore I think they're going to stay on this path that they're on, which is not other than interdiction on the water and keeping them from being able to move oil and get resupplied into their country. Keeping that from happening, I think, is likely the path that we're going to be on until either we get a negotiated solution to this that is acceptable to us, or we actually see the market start reacting in a way that put more pressure on getting a resolution. And thankfully, that's not what's been happening. Markets have been pretty resilient, and even if you think about it, it's not just U.S. markets, even foreign markets are somewhat resilient. If we look at in Europe, which clearly is probably facing even more pressure because of their dependence on imported oil, if I look at the European stock 600 today at 602, the all-time high for them is 636, so they're down 34 points. That's about 4 or 5% from their all-time high. If you think about it, it would make sense that they should be down a bit more than the U.S. is, given how much oil they import, and you compare that to how much oil we produce domestically, that takes some of the pressure off on this for us. We're paying higher prices, but the reality is a lot of that money is going to our own oil companies, our own producers. And so ultimately it's still staying in our economy. They're in essence buying stuff from the outside of Europe to bring in the energy, and it would have a bigger impact. But still, if you think about it, a 5% pullback on a major market indice from basically close to all-time highs, because those all-time highs were right here before the war began, and actually towards the end of last year is where actually February 27th, war began the next day. That was the all-time high for the European stock 600. It makes sense that they wouldn't be as close to all-time highs as we are, but I would still suggest that that's a pretty modest reaction to the magnitude of what has happened from a geopolitical perspective. If we look at some of the after hours news, we did have 4 big tech bellwethers that announced earnings after the bell tonight. A couple of them were positive when I checked them last. A couple of them were negative. Let's just take a quick look at those that reported. I know that Microsoft reported, and Microsoft at the moment currently modestly positive, up about 0.5%. So not a big move, but you can see here in this segment of the chart, this is how much the stock popped, then dropped, then popped, then dropped, just since 4 o'clock when they announced earnings. But still somewhat, again, range bound, up modestly at the moment. If we look at Amazon, I think Amazon was slightly positive when I checked it previously, and it is. Actually, it looks like it's more positive now, up 3.82%. So you can see in after hours trading, it initially dropped and then has rallied. My assumption is that they may have their earnings call, and the analyst, got some information that wasn't part of the initial report that has added to the optimism on Amazon. But Amazon was up today, and it's up after hours. If we look at Google, that one definitely was up previously. Sure enough, up nearly 6.5%. Since they announced earnings today. That one is positive. One that was down significantly was Facebook or Meta. And let's see how that one is reacting at the moment. And sure enough, that one is actually down about a little over 6%. So you've got 4 of the Mag 7 that reported earnings after hours. Microsoft modestly positive, Amazon, Google nicely positive, Meta pretty significantly negative. So clearly, by and large, more good than bad. And if we look at the futures for tomorrow, you can see the NASDAQ is up about 0.5% right now. So collectively, those big tech companies that have a big impact on the NASDAQ, that has been working in their favor. Just taking a quick look at also, Kevin Warsh, not only did you have a Fed meeting today where they left rates unchanged, but it does look like Kevin Warsh, President Trump's nominee to succeed Chairman Powell as chairman of the Federal Reserve, that his nomination did get voted up in committee, so it's now going to go to the floor for confirmation. Expectation is that he will be confirmed. But one of the big pieces of news was that Chairman Powell, in his press conference today, right here, says he will continue to serve as a Fed governor, and calls Trump criticism unprecedented, and basically says that he is going to stick around as a member of the Federal Reserve on the board until he feels that the threat of Fed independence has been addressed. So a little bit of unprecedented news, in the sense that he will be the first chairman of the Fed, at least in my lifetime, or the ones that have been around since I've been in this industry, which Alan Greenspan, when he left, as chairman, he did not stick around on the Fed. He actually went into retirement, went into the private sector. Ben Bernanke, as soon as he was done as chairman, he left. Janet Yellen, when she was done, she left. Now Jerome Powell is not leaving. So definitely an interesting dynamic as it pertains to the Federal Reserve, and at least today the market did not have a significant reaction to that. But for a Fed, if you think about it, it would be kind of like a president when he's done with his term, sticking around and hanging out in the cabinet, right? And it's like, yeah, I'm not quite leaving yet, and I'm still going to be in a position of pretty important level, not my old position, but still one that's relatively close to that, and I'm going to stick around and still try to have an influence. Market didn't really react to that news today, but I got to say that was a little bit of a surprise because no prior Fed chairman, at least in recent modern history, has done that, and yet Jerome Powell is choosing to do that. We'll see what that means for the Fed and their trajectory on interest rates as we head, into the middle to latter part of 2026. One thing that I would say is that our expectation for rates, if you can get a resolution in Iran and get oil prices heading back down to where they were prior to the conflict itself, and you combine that with one of the biggest elements of inflation is what is called owner's equivalent rent, which is basically what people pay to rent apartments or what you would pay to rent a house. And those numbers are actually coming down. And you're basically seeing rents modestly starting to decline, and that makes up 38% of CPI. So almost 40% of CPI is owner's equivalent rent, which is actually going down, not up, which that's one of the reasons why core inflation is still hovering right in that 2.5% range. And because you've got one of the biggest components coming down in actual price, not a slowdown of increase, but an actual decline in prices. So if you get that to continue for a period of time, and then you get oil heading back in the right direction, lower, the combination of those two things likely opens up the opportunity for the Fed to actually begin to cut rates more earnestly as we get further into the year. But until we get a resolution in the conflict in Iran and you get oil prices heading down, I fully understand why the Fed has taken a wait and see approach and decided not to cut rates, not to raise rates, just kind of watch how this plays out. And we know that as long as oil prices are as high as they are right now, there's pain at the pump. There's definitely, price increases on the things that are tied to energy costs. But the expectation is those could come down quite rapidly. And then if you combine that with rent actually coming down, and that being such a big piece of CPI, that you actually could see a more aggressive Fed in cutting rates later this year, you wonder if Jerome Powell staying on the Federal Reserve Board, even though he's no longer going to be chairman, if that might muddy that potential up, especially given the fact that clearly he and President Trump do not have a good relationship. I think that's an understatement. And you wonder if Powell may stick around just to kind of make it harder for President Trump to get rates down, which that his new Fed chairman certainly is at least more favorable towards that approach. I would suggest that everybody's kind of in a wait and see mode at the moment, given what's going on with oil prices and what's going on with the conflict with Iran. But I would say stock market staying pretty close to all-time highs in spite of those higher oil prices, higher interest rates on the 10-year. I would suggest that that is probably going to give us more of what we have been seeing, which is more of the blockade, more of just kind of letting this play out and putting more and more pressure, building pressure on Iran to capitulate. And we'll see if that, if that has success or not. But clearly the market at the moment appears to be betting as though it will be successful. But I will say I do believe that it's staying in this range in spite of those higher costs, because they're happy that we're not escalating, but they're also happy that we're not just declaring victory and going home, because the job probably, isn't fully accomplished yet. And maybe their military objectives are accomplished, but clearly they haven't gotten the uranium yet, and they also haven't had a official change of leadership that would be more acceptable to the rest of the region or the free world, especially as it pertains to what's going to happen with the Strait of Hormuz and the free flow of oil. So thank you for tuning in to our update tonight. The good news is we are able to record these now and archive them. So this update is going to be available probably tomorrow sometime for anybody to be able to rewatch it. We are not doing the morning update on Thursdays. Now that we can archive these, we really don't need to do them twice a week. If we want to have a special event in office, we may still do updates during the day, but in general, we're going to try to record them after the market closes on Wednesday, give our midweek update, and ultimately then archive that moving forward so people can watch it at their convenience, which is something that we're excited that we can now do as part of LPL, and very thankful for that. So thank you for your time this evening. Thank you for your faith in our team. And until I see you next week, stay safe.